Okay, good afternoon, guys. Welcome to this monthly presentation on fxstreet.com. Hopefully everyone's turned up that's going to turn up now. So what we're going to talk about first is all about a trading plan and the trading theory behind it. Very important when we're trading these volatile markets that we look at why we're trading, how we're approaching the markets, what our attitudes are. All these things, if we put them in the right format to start with, will help us to trade and really should make us better traders. Okay, so more just welcoming you all to the presentation. I think everyone should be here now, so I'm going to begin. So again, this is the first module of a 10-module course that I've written. So it really does give you all the foundations, all the ideas that you can take away from this, and how you can then set up strategy for trading the market and being the most profitable trader you can be. Okay, now before I start, as always, I need to read you a risk warning. Now, spread betting and CFD trading both carry a high level of risk to your capital, with the possibility of losing more than your initial investment. These products might be suitable for all investors and are only intended for people over the age of 18. Please ensure you're fully aware of the risks involved, and if necessary, seek independent financial advice. Stops are automatically allocated to each trade and if triggered are subject to market gaps unless you specified for your trade to be guaranteed. Again, this is educational only. The content of the webinar is not the personal opinion. The personal opinion is the moderator, not intertrader.com. Content does not constitute investment, financial, or tax advice. You're advised to discuss your specific requirements with an independent financial advisor prior to entering any bet. Intertrader.com is not responsible and disclaims any and all liability for the content or comments during this session. Okay, guys. So when we talk about trading, people often ask me, "What's the best way to become a successful trader?" Now, unfortunately, there's no definitive answer. Again, I've traded the markets for years. I've managed some of the biggest trading floors in Europe. I've managed some of the biggest traders that are around today. And it's only by having these insights and seeing how everybody approaches the markets in such different ways that you can start to strip it back and really look at it objectively and say, okay, everyone trades in their own style. Everyone has their own views on the markets, and that's how the markets come together. That's how we get market sentiment. But it's how we control our own actions, how we manage our money, how we manage our expectations, and how we actually trade ourselves. This is the kind of important thing that we really need to know when we're going into the markets and we're trading, that everyone has some sort of plan, even if they don't know it. Everyone's got some sort of goal they want to achieve, and it's mainly money. But again, through my experience and through the different types of traders I've experienced and taught over the years, it's very easy to get caught up in the markets, get caught up in the emotions and make decisions without having any kind of rationale or real rationale behind it. So what this particular module tries to explain to people is that if you take a step back and you think about all the things you're trying to achieve, and it's not just a money element. You know, we all want to achieve good trades, we want to achieve success, we want to be happy with what we're doing. And if we think about this, we put some simple goals in place, put some simple strategy and plans in place, really what we're going to start finding is that we can really approach the markets in a way that we're always going to be set, and that's going to give us an edge. Okay? So trading is almost an art form. It takes a long time to be an expert, and I don't really think you ever master it. So it's all about being constantly being able to learn and adapt to the markets. No two trading sessions are ever the same. No two trading days are ever the same. So again, there's all these different parts that are ever changing, all this information we have to assimilate, at a fairly rapid pace. And again, it's all about how we plan and prepare for the markets, which is going to give us the ability to get that edge and to trade and be successful. So again, the main point I'm trying to put across to anybody who wants to trade successfully is that you have to plan, you have to be prepared, right? Give yourself some points of reference, something to start with and build on, okay? Don't want to use cliches, but trading is a marathon, it's not a sprint. If you expect to turn on your screens, start trading straight away and make your fortune, it's very, very unlikely that's going to happen. But if you do invest a bit of time in yourself, in the way you feel, in your education, in your planning, in the research you do to the markets, then I'm not going to say you're going to be a massively successful trader, but you've certainly given yourself every opportunity. So the basic concepts of a trading plan. So when I talk about a trading plan, I believe it should be written. It should be something that's physical in front of you at all times. So I'm not saying that you have to have a big printout, that's professionally done, or you have to have, big whiteboards, anything like that. Your trading plan can be as simple as you want it to be. It can be as simple as having post-it notes with some key levels, that you've maybe seen happening over the last trading session or the last week, levels that, building up towards the high side or the low side that could test and make a big breakout or a big reversal. It's things like noting down candlestick formations. If you look at your daily patterns, perhaps we're seeing a shooting star, or our dojis, maybe we're seeing that the market is set for a continuation of its particular trend, or the market's looking to reverse. And it's only by looking at the closes of our daily candles can we know what's going to happen in the next trading session. So again, it's just that whole point that's going to be the recurring theme throughout this webinar, all about being prepared, being ready for every eventuality in the markets you choose to trade. So there's other things we need to look at. Okay, so not just how will we trade, but there's also where will our stops be placed? Where will we get out? Give ourselves these reference points. Yeah? So if we do something, we need to go back. We need to read, learn, and adapt from it. So if we don't have a trading plan, we don't have some rules in place. Okay, how can we go back? How can we assess what we've done? We can only really look at our P&L, and if our P&L is green, or we've made money, that seems to be a good day. If the P&L is red, and we've lost money, that seems to be a bad day. But that's one-dimensional when you're talking about trading. Okay, it's not always about the money. I mean, don't get me wrong, it's 99% about the money. That's why anybody trades. But it's how we do it. Sometimes you can be right in the direction of the market and lose money. Sometimes you can be wrong and make money. This is how complex the markets are. So again, a lot can happen emotionally. A lot of things can happen in a short space of time. So with your trading plan, that almost becomes a trading log as well. If you write down what you did and the reasons why you did that trade, and it can be very, very simple. It could be a few lines, a few words even. And if you look back through this when you're a little bit calmer, when you don't have positions on, and it's the end of the trading day, you may be able to see a pattern emerge. Maybe this is something that I learned at a very early stage in my career. I was more of a morning trader than an afternoon trader. So I generally tended to make money in the mornings when the US markets weren't open. And when the US markets did open, I tended to have a lower success rate with my trades. So these are things you can pick up just by writing down simple things that at 3:01 today I traded the S&P, bought at this level because of X, Y, and Z. So again, if you don't write that down, how will you know? Unless you go through your statements every day, or unless you go through your trading activity. Because so many things do happen, how are you going to be able to keep a reference point of what you did? And more importantly, why you did it? So again, when you're a trader, you're the person, okay? You're the person that trades, your own risk manager, your own economist. You have a lot of responsibilities, a lot of things to do. So again, you have to approach it more as a business, okay? So if you wanted to go and open a flower shop, for example, you'd want to know certain things, how much stock you needed, how much your premises are going to cost. So when you talk about a trading career, or trading for a living, or any kind of serious trading to make consistent money, there has to be a plan in place. You have to put some rules in place. And remember, you've got no one to be accountable to. These are your rules. So if you don't stick to them, you're only breaking your own rules. And sometimes that's very easy to do, especially when you're talking about trades that are going offside and saying, okay, well, my stop was here, but for X, Y, and Z, I think I'm going to let the trade go further offside and risk even more of my capital. But then again, if you haven't got your rules in place, how do you know, again, where you're going to get stopped out, what that means for your capital in total, what that means for your ability to carry on trading? So these are the things you need to ask yourself, and then why you put them in place in the first place. There's no point making rules if all you do is break them. And again, it's not to say that you can never bend or break the rules. It's your trading plan. You can do as you like. But if you don't have these simple goals in place and rules in place to start with, then we're really kind of trading blind and just trading for the sake of it. Okay, so it's important to remember that your plan should encompass all the aspects that we're going to learn from in this course. So obviously there's 10 more modules from this, but we'll go through some other parts, and we'll go through some other kind of techniques that we're going to do. And when we talk about trading and trading plan, that's the very first step. After the trading plan, we need to know about our fundamentals. that are driving the market. We need to know about our technicals that are moving the market. We need to know about our psychological state. I mean, there's a lot of things to know, a lot of things that we can learn about ourselves, and we're going to cover in different modules. But right now, we'll just concentrate on the first thing, having a plan, why we should have it, and why it's going to make us a better trader. So the next kind of 4 points. We all know at the minute the markets are very volatile. Okay, the volumes are up on previous years. Previously, markets could move 1 or 2% in a day. You know, quite regularly we see markets move 2, 3, 4% in a day. So that's going to change how you trade. Okay, if markets suddenly move 30, 40 ticks in a straight line, how does that affect how you trade? Does it affect the size you trade? Okay, does it affect where you're going to put your stops? Does it really affect the type of trader you're going to become? You know, if you're looking to scalp the markets, should you really now be a position trader? These are the things you need to think about. So number 2, what time of the day you're going to trade? As I mentioned, I was a morning trader. Some people are afternoon traders. What's going to work for you? So number 3 is what products suit your risk? Yeah, there's a lot of products we can trade, from commodities, FX, stocks, to all sorts of things, to bonds. Anything we want to trade, we can. But what's going to suit your risk? Okay, what's going to suit your trading style? And number 4, what is my overall risk strategy? If you don't have a risk strategy, then how do you know how much you want to make and how much you're willing to invest in order to realize that profit? So as I said, it's very important we have a trading plan. But again, as I mentioned, yeah, it's very important that we have the ability to change this trading plan if things don't go as predicted. The trading plan, once you've written it down and you have some basic rules in place, it's giving you some sort of structure. But again, we have to know when to amend and when to change the system. When something's not working, we need to strip it out and replace it with something else. Yeah? Markets are like an organism, okay? They're constantly changing, and we're never always going to get it right. As we've said before in many different presentations, that we have to accept at some point in time we're going to have a losing trade. But it's how we manage that, how we deal with that makes us the trader we are. So it's very important we have the ability to change our plans and change the way we're approaching the market if things aren't going as predicted. Okay? So it's very good that we've got a disciplined approach and trading plan, but then there are some points that we have to drop. So again, this goes back to all the different things you're going to have in this trading plan. Maybe we look at our technicals. So we're trend trading at the minute. So we're going with the trend. We're looking at our oscillators, our RSIs, our Bollinger Bands. But then all of a sudden, maybe the markets have changed. They're not trending anymore. They've gone into a ranging pattern. So we're just picking tops and bottoms, points to let the market oscillate, to go up and to go down. So we're not going with momentum anymore. So therefore, we have to change our plan according to the market conditions. So then again, we don't look for breakouts of levels. We don't look for continuation patterns. As again, we go back to our basics. We look for daily candlestick formations. We look at reversal patterns. We look at all the things that tell us that the market isn't breaking out anymore. It's ranging. And we adapt our trading plan for that particular trading period appropriately. So again, a good example of that could be that if we know a daily level has been hit 3 times on the upside in a trending market, yeah, and the overall trend is bullish, we expect a break of that, and then we see the momentum take the trade higher. But if the market then changes and consolidates, we see the volumes go down, and it turns into more of a ranging pattern, then we look for them levels again, but instead of them being broken, and we look to trade through them and make money, we look for them to hold. And once they bounce, we then sell into the reversal. So that's just a quick illustration of how we can quickly change a trading plan to suit into the market conditions. So the markets aren't breaking out, we don't have the volume, then it's more likely we're going to go into a ranging market, and the markets are going to not break through, they're going to reverse. So that's a quick example of how we can just change our trading plan. And again, we're aware of it. As soon as we write it down, we're not looking for the breakout anymore, we're looking for the reversal patterns. So we're already getting in tune with the market. So these are little techniques that just by writing these simple little lines down to say, okay, the market hasn't broke through, the volumes are down, therefore this looks like it should be a ranging day. So don't look to buy through levels, don't look for breaks, look for bounces, look for reversals. So again, that's just a very simple technique that you could write down at the beginning of your day or beginning of your trading session that could mean the difference between having winning trades and losing trades. That's not a lot of effort. So remember, the trading plan is a physical reminder of what's best for you and for your trading account. It's all about you. It's all about your trading style and you as a trader. So it's only ever designed to be on your side. So trading plan. Okay, when we talk about goal setting, this is something that's very, very important when we're trading, to have some sort of physical outcome of something we want to achieve from that trading session. Now again, because it's trading, we always look at it in money. But that again is very one-dimensional. If you only ever look at trading in money, it becomes a little bit soulless and you can lose your focus and it can mean less when you make money. No, it sounds hard to believe, but again, it's just something I've experienced myself over the years, that it's more about being right. That's the power of trading, is getting it right when other people get it wrong. That's the buzz of trading. That's why we get so excited. The money is almost like a byproduct. Yeah. So it's generally the way it was explained to me as a very young trader by some very, very successful traders, is that trading's a game and money's just a way of keeping score. So if we look at it that way, then, we all like to take trading seriously, and we should do. But we have to remember, we're in the markets, we're trading against other people, and what we're trying to do is make a right trade, and that needs to be our goal. So it's easy to say what should be included in the trading plan and so on and so on. But it's all down to how much you're willing to put into it effort-wise and develop it. So your goals are another way of adding to your trading plan and make sure you're in the right frame of mind, that you've actually thought about what you're trying to get out of this trading session, what you're trying to achieve out of the markets. So we have our outcome goals, which inevitably, as we always say, will be to make profits, be it, daily, weekly or yearly. Set yourself a realistic target. Some people like to say, okay, well, today I want to make X amount of money, but maybe, some other people are looking a little bit longer term. Say, okay, well, I'll take each day as it comes, but on the week, I'd like to make 10% of my overall capital. Yeah, maybe people extend that, go monthly, go yearly. Again, it doesn't matter. Again, you're the trader. You should understand what you're trying to achieve, and you should be aware of what you want to achieve. So as long as you've got some sort of outcome goal where you want to be, then we know we can start to work on how we're going to get there. So process goals. So without a process to make you profitable, you're never going to really reach your outcome goals. So we need to put process goals in place, like little milestones, in order to get there, to get to our overall final destination. So again, it's just like anything that we do in life. Anything, we want to be a golfer. We don't just buy a set of clubs and say, okay, by the end of the year, I'm going to be Tiger Woods. We have to be realistic. Yeah, by the end of the year, I want to play off a 10 handicap. Process goals for the next month or next 3 months. Every week I'm going to see a pro. I'm going to learn how to drive, how to chip, how to putt. I'm going to practice, every other weekend. Yeah, so by the end of that year, our outcome goal will be that we should be playing off a 10 handicap. So it's just like anything that we would do in life. Without knowing where we want to go, yeah, then how are we going to get there? And if we don't have these little steps in place, you're always trying to fight against yourself and trying to take too much on. It's all about breaking things up into manageable chunks. Okay, so you can't read a full novel in a day, but you can read a chapter a day and finish it over a couple of weeks. For instance, it's all these different analogies I'm trying to put across to you, that you need to set your goals in accordance to what you want to achieve and where you want to be. So if you want to be a trader that makes £10,000 a month, then you need to know how much you need to make a day. You need to break it down into that. Then how are you going to approach that day? How are you going to make sure you hold your gains, your profits, without giving them back to the market? When you do have a bad day, how do you react to that? How does that fit into the overall scheme? Yeah? So these are things you need to think about when you're setting your overall outcome goals, then setting your smaller process goals. And you can put these into your trading plan, and you can look at them, and they're physically there in front of you. So you're constantly reminded why you sat in front of your screen in the first place. And then obviously, if you're putting your process goals, how are you going to achieve it? So goal assessment. So this is not just the monetary value of what you want to make. Every trader's goal, as we keep mentioning, is to make profit. You need to break your goals then into two areas. So I'd say your overall goals, as we talked about, your daily, weekly, monthly, and your individual trading goals, right? So what is the risk-reward ratio in each trade you're entering? What's your exit strategy? What's the optimal return on this trade? Yeah. So how far are you wishing to see it go inside, and what's the point for it to go against you? Are you gonna cut out that trade? Are you gonna realize the loss and stop trading? So again, if you don't write these things down and you don't write these goals down, how do you know if you're going to achieve them or not? So again, it would only just be by looking at your P&L. Yeah. If you don't look at your daily trades and how you went about your trading process for that day, then it's very easy to get lost. And then by the end of it, if you're looking for a monthly target of X amount of money, you're not really going to know when you're on track. If you don't look every day, as we said with your process goals, how do you know how you've got there? Yeah, did you make all that money in one day of one big comment, or just one big trade? Or did you systematically make money every single day, because you've broken down your monthly target into daily targets in order to achieve that? Yeah. So again, it's just different ways of thinking about it, different ways of making this trading game, this trading career more tangible and giving you more of a structure to it. So you can ask yourself the following, what type of trader are you? Yeah, these are things we need to ask ourselves, because people like to put themselves in a certain bracket and like to say, yes, well, I'm a scalper or a momentum trader, So ask yourself, what is your style? Are you swing, momentum, scalper? Do you trade fundamental? Or you're a mixture of some or all these types? Okay? It's worth noting, you don't want to limit yourself, but remember, you can't trade everything. So as in you can't trade every product, you can't be every style of trader. So again, it's very important that we write this down into our trading plan, because maybe we get caught up in the noise again. So we're trying to scalp, make very small profits and trade often. Yeah, but maybe that isn't working. Maybe we could just do one trade or two trades in that session, and we make more money by letting the trade go in the direction we think the market's going to go and putting our stop out a little bit. So we're giving ourselves more room to breathe. So we're not instantly right and taking profit. We're letting the position build up slowly and then allow it to go further on side in order to take bigger profits. So number 2, how much risk will you take in each trade? Okay, so this is something else that refers directly back to your trading plan. Will you trade 1% of your account in each trade? Okay, so very, very important to know. If you're a longer term trader, you will obviously trade less often. So you might want to trade 2, 3, 4, 5, 10% of your capital on each trade, because you're not trading every day, you're trading once a week. So again, it's all what fits in with your style of trading, all what fits in with your attitude to risk. And these are things, you need to have written down and physically put them in front of you. Because again, if you don't have this information to hand, how will you review it? And how will you set these goals and be able to achieve them? And then number 3, what's your risk-reward ratio? What are you going to employ on these trades? So again, this is a question I get asked very, very often. What's the correct risk-reward ratio on any trade? It all depends. It has to be a minimum of, 2 to 1. So you're looking to profit by 2 times more than the amount you're willing to risk. But that can change up to 3 to 1, 5 to 1. It really just depends on what style of trader you are. If you're a scalper, then your risk reward has to be very, very small, because every time you're wrong, you cut out for a loss immediately, and every time you're right, as Solman's saying, you take your profit straight away. So you need to make sure that you know your overall style of trading, so you can put all these things into place, and they're the right strategy for you. There's no point putting a very, very small stop if you're expected to make 100 ticks out of a trade, because more likely than not, you're not going to pick the perfect entry point and end up, getting out of that trade for a loss, because you're not giving the market, so you're not giving the charts enough time to create the pattern. of the trend you're looking to trade on. So again, what sort of trader are you? So before you even begin to think about anything, you need to find a style that suits you. So as I mentioned before, there are many different types of trades and traders. So when it comes to the style you employ, you need to think about what's going to suit you, what's going to suit your outcome goals. So ask yourself the following. Yeah, are you a swing trader? Okay, are you a momentum trader, a scalper? Do you only trade fundamental news? Or are you a mixture of some and all? Now, in my personal opinion, these days, with the markets being the way they are, I'd say that you have to be aware of fundamental news because the markets are moving off rumours. There's a lot of things happening in the Eurozone that we're obviously all aware about. A lot of things happening in the global economy that we're aware about. So we have to understand the news that's coming through and how it affects our market. That's not to say we can't be technical traders. Technicals are absolutely imperative. Every trader that trades the markets will look at some form of charts. So we have to look at patterns building up. And we have to be able to interpret what the markets are doing. So I would say that really everyone has to be aware of technicals and also be very aware of the fundamental news that is driving the market. So it really comes down to then how much you're looking to make out of a trade. So if you're a swing trader, you're looking for more of momentum to come back into the market and try and make money that way. If you're in momentum, you're looking for breakouts. You're looking for things to go in particular trend with a lot of momentum behind it and move a relatively large amount of ticks in a short space of time. Or you're a scalper. You just look to get into a trade, get on side, take your profit and look for the next opportunity. So it's by identifying these things, identifying the style that suits with you, you can then go back and put a risk-reward strategy around it. As we've said, there's no point employing a 2-to-1 risk-reward scalping ratio if you're going to be a swing or momentum trader, because the likelihood is they're not going to fit together and you're going to end up getting stopped out of your trade before you've given the trade enough time to like we say, let the market do what it needs to do and go in the direction that you've identified. So again, as I said, fundamental and technical, you can mix the two, but then you have to base your plan around it. If you're a technical trader, then maybe just put a note of the fundamentals that are coming out that day. So you look at your figures, for instance, you look at your key speakers. So if you're holding a trade for maybe a few hours, if non-farm payrolls is coming out, we need to be aware of non-farm payrolls, what it is, what it could do to the market, and if it does come out of line, is that going to help or hinder our trade? So maybe, before non-farm payrolls, we get a bad feeling, we cut out of our profit, and we wait for the figure to come out and trade off the back of it. But again, you have to be aware of what's happening in the markets, because this is what's driving it at the minute. Yeah, news, rumours, and things that are happening in the world are making the markets move. So just by being a technical trader and just going off trends and levels, if you're not aware of what other traders are looking at and listening to, you can be at a big disadvantage. So again, you can always do too much. So when we talk about your risk management and your capital management, when we talk about trading plans, you can almost try and make it too complex. You can go into too much detail. Yeah. The whole point about all the things that I'm trying to put across is that as long as we're aware of the basics, okay, we're aware of our daily levels, our highs and lows, we're aware of the overall trend, we know what key speakers and figures are out that day, yeah, and we know, or we have some idea of what our goals are. That's 4 things that could be the basic trading plan. So that's going to take 5 minutes to do, yeah, less than 5 minutes. But just by doing that, you've given yourself a little bit of structure, a little bit of an edge. You know where the market could extend to on the high and the low side. Yeah. You know what the overall trend is, so you're going to be buying or selling that day. You know what time the figures are out. So if you don't want to trade around them, you can just sit back and wait for the figures to come out and trade off the back of them. Yeah. And we know our goals. We know how much money we want to make. We know how many ticks we want to make. These are the things, again, that are going to give us that little bit of structure and allow us to take on the market. And it will give us confidence. And it's not just me saying this because I think it will. I know it will. I know it will. I know it does because I have done it. And I've taught a lot of people to trade this way. and they have gone on to make money. So this isn't theory. It's the theory of a trading plan. But the things I'm telling you are actually true and do work. As long as you're willing to put a bit of time and effort in and invest in yourself, then you can't lose from it. It won't hinder you. It won't do you any harm. It can only do you good. But again, these are just things that I've done in the past. And as always, I'm just giving you the benefit of my experience. So what markets will you trade? Okay, so the style of trader you are can sort of, in some instances, dictate the kind of markets you look to follow. So if you're a swing momentum trader, maybe you might trade commodities, things like oil, WTI, Brent, because that's the way the markets tend to move. They'll be very, very quiet for periods of time, and suddenly there'll be a big straight line move. So maybe that's how you dictate what style of trader you are. So most FX traders are generally position-based swing traders because obviously large fluctuations take place and give you the opportunities to trade. So obviously we know that the FX markets are the biggest in the world. Around about 4 trillion is traded every day. So that's a lot of opportunities. So if the markets are trading them volumes and are moving, then why are we looking to be scalpers? Why are we looking to make 1 or 2, 3, 5 ticks out of a trade when we've got such big daily ranges and such large volatility? Yeah, if you want to trade small and make 1 or 2 ticks, maybe trade a slower moving market. Maybe trade something like the bond markets, for instance. They tend to move at a slower pace than the stock markets. Yeah, FX moves quite quickly, and as we've just mentioned, so do commodities. So again, it's just doing that little bit of research into what you're trading, what the daily volumes are, how big the candles are, to understand if you should be scalping that particular market or positioning yourself for a bigger move. Yeah, so the markets have their own characteristics, like traders themselves. Some are very volatile. Yeah, some have more participants, therefore market size. So that, the bid and the offer, there's more people on each bid and offer. So the key here is really to recognize how you trade and what product suits you and stick to it. Quite often, when I was on the trading floors, I'd see people with 6, 7, 8 positions on all at one time in different markets. And that's very difficult to do. It's not to say you can't trade multiple markets, but if you do have a particular market that suits your risk strategy and your trading plan, then why not try and master that one before we try and trade 2, 3, 4 products at a time? We can only concentrate on so many things at any one given time. And as I said, in a trading floor, you have a risk management team, you have a trading manager, you have economists, you have squawks, you have analysts. When you sit down and trade, we have to do all them things ourselves. We're our own trader, risk manager, economist. All these things we have to do. A lot of things to take on board. So again, if we haven't got a plan, how can we realistically start trying to make money in lots of different markets? So again, this comes back to experience and it comes back to how you plan. So that's all we're referring to. So other kind of examples, if you read the UK papers, like the FT, for example, you might want to start with trading the UK markets. Trade the things that are around you. If you live in Germany, you're going to know people that work in the big companies like Siemens, so trade the DAX. Maybe you'll get some idea of how well the company's doing, how well the economy is doing in its entirety. So again, these are just examples. We can all trade whatever products we want based on any criteria we want. It's just trying to give yourself that trading edge, the probability of success. That if you stick to not what you know, but really more what you're immersed in. So if you're walking around London and you're walking around the city every day, you're going to interact with other people. You're going to see how the banks are doing. You're going to speak to people. You're going to see if the shops are full. You're going to get an idea if people are spending money or not. So yeah, well, that'll reflect in what's happening in the bond markets, like the gilt, and that's what will obviously be a knock-on effect to what's going to happen in the FTSE, how the general UK economy is doing. So again, it's just about being practical. All the information we need is out there on the internet. There's so many different sources of information that again, it's very, very easy to read too much into it. So again, it's all about planning, being prepared, and finding out what is in tune with you, what pieces of news you like to listen to, what market commentators relate to the style of trading you're doing and your trail of thinking, and sticking to it. Because there's no point trying to read everything, because then you won't be able to build up your own opinion. Because everyone has their own opinions. And that's what I say to every trader when they start. Yeah? Your opinion is just as valid as anybody else's in the market. If you're trading your own money, you've got just as much right to have an opinion as anybody else. So that's what, again, it's all about instilling confidence and being prepared to put your money where your mouth is. So if you've got an opinion, you're putting your money on it, stick to it. Okay, Trying Traders just asking a question. What is a simple strategy could you suggest for a novice trader to master? Well, again, that's why it's such an expansive question, because there is no simple strategy. The whole point of having a trading plan or thinking about how you're going to trade, yeah, in its simplest term, a simplest strategy would be to have a goal, yeah, and then know how you're going to get it. So the simplest strategy I could give any beginner trader would be look at it in tick terms, so in market pip movements. I'm a new trader. I've just started today. I'm going to trade the FTSE. Out of the FTSE today, I would like to make 20 price movements. For that 20 price movements, I do not want to lose more than 10 ticks. So I don't want to cut a trade out, yeah, that totals in that day more than 10 ticks. So you want to make 20 on the upside and you're willing to stake 10. That's about as simple as you can make any strategy. So again, as long as you're trading relatively small size, it shouldn't wipe out your capital. You've got a realistic plan of what to go for, and you know where your stop is. So try and make 20 by risking 10. That means you can get it wrong and still have the ability to trade, and it will give you some idea of how long you need to run trades onside for, and how quick you need to cut losers before you hit that finite 10-tick stop and have to, stop for the day. And if you do that for a week, yeah, you should have either lost 50 ticks or made 100. So if you can do that, you're already halfway to mastering trading. So try it. Let me know how it goes. But that's about as simple as a strategy I could give you, without speaking to you, without knowing how much money you have, how much you're willing to risk, and what products you're trading. So that's about as simple as I can make that. But my view, again, just my view on how I see products, how they're fundamentally and technically weighted, and what type of trader they'd suit. Okay? So when we look at products like the FTSE, it's very, very fundamental, and it's also very technical. So I would suggest that's right for position and momentum traders. Now the DAX is very, very fundamentally based at the minute. Obviously the DAX is the German stock exchange. We know that Germany is pretty much the powerhouse behind the Eurozone, propping up most of the Euro, to be honest. So anything that comes out about the Eurozone, or anything that comes out directly about Germany, about its GDP figures, employment figures, again within the Eurozone, etc., etc., but anything that comes out directly affecting Germany, right, we need to look at that, because that can have an effect on the overall direction of the DAX. So again, I think this is designed for position momentum traders. So the Nasdaq, again, fundamental and technical. There will be a theme in this, because all markets will be moved by fundamental news. It's just the nature of the beast. But again, that's more position momentum, and can be scalped. It doesn't move as quick as other markets. S&P, very fundamental and technical. Again, very, very dependent on what news comes out of the US and what happens in the bigger economies. So I would say maybe a position. You can scalp it, in all fairness, because of the volumes that are involved. It's quite easy to get positions off and get out of positions quickly. So the Wall Street rolling daily, fundamental technical position. US crude, I'd just say very fundamental. You do have technicals, but crude really does move off the back of news. And so that's right for position and momentum traders. So we've got your currencies, things that, these are the most common ones that I've traded and other people I've traded with. So again, euro dollar, the pound against the dollar yen, and the Aussie against the dollar, all very fundamental and technical. Position momentum. Again, when you look at the the US dollar against the Japanese yen, don't forget, unless it's effectively pegged. So when we talk about the Japan pegging its currency against the dollar, very important we're aware of that fundamental news and if that's happening. And The Aussie dollar, don't trade it during the day. Yeah, wait till the US is closed. Gold, very, very important at the minute. Very, very fundamental. It is technical to some degree, but we're at new highs all the time. So it's all based on what's happening in the economy, the fear that's driving the price up. So I would say again, you need to be positioning and going up momentum. So your entry strategy. So when you this section is devoted solely to the system you're going to use to identify and then execute trades. Okay, so it's very important to have entry rules in order to facilitate optimum trading execution. So the system should be complicated enough not to give you too many signals, but then again, it shouldn't be too complicated that you never get the feeling that you need to push the button and press the trade. As I've said before, you can overcomplicate trading. There's always that fine line between doing enough to justify trading and then doing too much to justify not trading, and that's the kind of thing we need to think about. Okay, so we need to understand why we're getting into a trade and having that confidence to press the button. We're not just trading just for the sake of it. Okay, so you might find you want to trade different signals differently. So this might be the case that different indicators you use. Yeah, you need to size your trades accordingly. So what this means is, we can have different signals. So if we're trading technically, we can be looking for, as we mentioned before, like breakouts or trends to hold and turn and reverse. But we can look at other oscillators, look at things like the relative strength index, our Bollinger Bands, things like that. We need to look at all the things that kind of come together to give us the confidence to press the button that go with our overall feeling of the market. So when we look at our system of why we're pressing the button to get in, we need to just make sure that we're trading technically, that we've got all the things that we've talked about at our disposal. And then we need to know what has worked for us in the past, therefore what's going to give us the confidence to trade in the future. So the simple fact is, you don't want to risk your capital on a weak signal. So fundamental data is good to trade, because if a figure comes out strong or a figure comes out weak, we know generally what it should do to the market. That's our signal. But then when we're trading intraday just off technical levels, there's other things we need to look at. We can't just go off pure levels in respect to where they are in the market. We need to go off our other indicators to kind of back up what we're saying and what we're thinking and giving us that extra confidence to trade. So your entry strategy, again, is something you need to think about. And maybe again, it's just as simple as that if you see a fundamental piece of information and you understand what it means to the market, you just trade the size that you're comfortable with. Or it might be that if you're trading technically, that you say, okay, if the market breaks out, I will trade half my normal size. When it does break out, when it does go inside, I'll put the rest of my normal size back in, allowing the momentum to carry on and make my money out the trade. So that's when I say you need to adjust your size accordingly to market conditions. You don't always have to trade the maximum size that your capital will allow. You can build positions up. And again, with these markets being so volatile and being quite directional, that if you are right, the markets do have a tendency to overextend and overextend in one direction. So you can always build your positions up and make more of a winning trade. Okay, Book is just asking a question. Why not trade the Aussie dollar during the day? Well, basically because there's a lot of things happening across all markets during the day. When the US closes, obviously Australia will be open. So we have a lot less volatility from one side, and then we can trade off the back of it. So it's just giving ourselves that little bit of an edge. If there's less people trading because the US is closed, and again, you'd have to probably stay up during the night to do this, but if you could do that, and you're willing to do that, then the less people that are in the market, the more chance you have of getting that edge and being able to trade and being on the right side. When the markets do open, hopefully you're already on side, the momentum continues because more people are trading, more volume. So again, ask yourself the following questions. It's all about asking yourself these questions and giving yourself some answers. That's how we learn as human beings. So number one, so what technical fundamental analysis are you going to use to enter a trade? Yeah, you're just going to use your trend lines, or we're going to use our reversal patterns, like our candlesticks, or as I mentioned before, are we going to use our oscillators? So these are the things we need to think about. It's all about, again, planning. If we know we use oscillators like RSI, and we generally, sell when the market 75 is above the 75 mark on our RSI, because that means the market's, overbought. So we're going to reach a reversal pattern that we can look at on our candlesticks. Therefore, the market comes off, and that's when we trade. So again, if we're not aware of what we're using, then how do we know how to use it in the future and make money? So number 2, what signals are optimal? What's good? What's a weak trade? How do you identify it? So you may want to risk more on an optimal trade signal rather than wasting time on just trading signals that are just good or just a weak signal. So again, that's all about capital management. It's all about using your money in a more sensible and more proactive way. That if you wait for just the optimal signals in your trading strategy and just trade them, then you're not getting caught up in the noise. You're not just trading for the sake of it, and you're making sure that every time you press that button, the likelihood of that being a successful trade is higher. So number 3, how will you trade unscheduled news events that might occur? Okay, where will you look to get in? When we look for the confirmation, how we know what's the best price? Now all this means is that things are said every single day in the markets by our key speakers, people in government, market commentators. Again, there was a comment in the markets a couple of days back that the German government had talked about letting Greece default. So the German bond market, shot up 45 ticks in a straight line. That's an opportunity to make money. But again, if you're not understanding the fundamental reasons and how fundamental news will affect your market, how can you benefit from that? How can you make money from it? These are little nuggets, the little gems that come along, not very often that is, but will generally come along once a month or once every 3 months, that you can put sufficient capital on to make a very, very good winning trade. And that, in monetary terms, that could equate to a week's money, 2 days' money. Again, these are things we need to look at and make sure we build them into our plan in some respect, because these are things that are going to take you to the next level of trading and make you much more profitable. So if you know when people speak, when figures come out, how they affect your market, it gives you an extra dimension. That when the markets are trending, you can make money that way. When markets are consolidating, you can make money that way. And when news comes out that fundamentally affect your market, you can make money that way. It's all about maximizing the opportunities to make the money out of your market. So as long as you know what figures are out, what speakers are scheduled to speak, and what they could say, and where they could affect the direction of your market, then again, at least you're on the same footing as everybody else. So when these comments and figures do come out, you can trade them with confidence and try and make money from them. So we've done the entry points. So what about the exit signals? Where we're going to get out of the trade? So it's quite important that you must know where your out is before you put the trade on. So it might sound obvious, but it's not. Generally, a lot of people put the trade on and don't actually have any real idea of where they're going to stop themselves out on the downside, or where they're going to take the profit out when it reaches it. It's all very well saying that my trade's on side, I'm going to take it out at the high. Well, how do we know what the high is? What's the high of the day? What was the high of yesterday? What high? What are we looking for? Okay, so it's very important when we talk about, in the beginning section, our goals, that we have our goals in tick terms, in money terms for each trade. So if your trade goes on side, then you say, okay, well, this is a position trade. I've waited 2 hours for this. I'm doing it for this and that signal. The market's moved 100 ticks today. It's near its lows. I think this could realistically go 30 ticks. That's your exit point. So if you say to yourself on the lows of the days, if it starts breaking through the low of the day, I'm probably wrong. My view on the market is not right. So I'm going to get out the market. I'm going to get out of that trade for a loss because that's not going with my trading strategy. So again, it's simple. And when you trade, it's all about emotion. So traders everywhere get attached to the trades, and it's hard to become, objective or subjective. It leads to a poor strategy. Number of times as a risk manager, I had to stop people out of trades and send them home for the day. And it's because they didn't want to realise that loss. So they were holding on to the trade because they knew it was a bad trade, they knew it was going against them, and they knew what it was going to mean. They knew it was going to mean that they lost money, that was the trading day over, and they didn't want to take it out for that reason. However, if you know you're wrong, what's the point of losing more money on it when you know you're wrong? If you've got a good enough strategy and, a good enough awareness in place, when the trade is not feeling right and the trade is going against you, then you cut out of it immediately. You stop the trade and you say, okay, well, I wasn't right at that point because it's not going in the direction I thought. What I'll do is I'll get out for a very small loss. I'll wait for the market to start going in my direction, then I'll trade again. And then you're just going to be doing the same as other people. When we talk about trading and self-fulfilling prophecy and the market sentiment, if you're getting out of that trade, because it's not feeling right, other people will be getting out of that trade. Therefore, the market will be going in the opposite direction you thought because people know they're wrong. So when they know they're wrong, that's fine. The market comes off. And then, when everybody's out, the market can then go in the direction that you all thought it would. But there's no point letting it go all the way against you when you know you're wrong. Let other people deal with that. Get out of your trade. When it does start to come back, buy it at a cheaper price. Buy it, and then all of a sudden you're back to your entry point. So you're in profit already, and then you can make even more money. So there's no point holding on to it all the way down and then letting it come back to your entry point. That's just taking a lot of stress for no reason. Okay, so there's a fine line to holding trades and being greedy. If you master this, you're ahead of most of the traders out there. So it all goes back to your goals and about being realistic. That if you are realistic in almost a mathematical way, if the market's moved, like I said in that example, 100 ticks that day, and you're looking to make 20 or 30 ticks, then, that's realistic, that's achievable. But there's absolutely no point if the market's moved 50 ticks in that day to say, well, I'm going to make 50 ticks out of this trade, because you're going to have the optimal entry point and also the optimal exit point. These things just don't happen in trading. It just isn't that simple. Okay, we've got a couple of questions. I'll just take a second. Do you have a technique that helps follow price action? Would you re-enter a second time if you've got an entry time you're wrong the first time? Okay, the first question, a technique following price action. I simply look at the bids and the offers. Now, when you're talking about looking at price action, you're looking at somebody or the market buying and selling against each other. So what I look for is I look for blips. I look for quick movements. And you can see this even on your spread betting platform, that, you'll be trading at a certain price, then all of a sudden the market will almost hesitate, and then it will go two prices in one direction. And that's somebody trying to force the market, out of its comfort zone. So these are things you need to look at, because they're either going to go with that force in that momentum, or these people are going to be wrong. Then you see the market quickly come back and go in the opposite direction. So that's how I look at price action, for them 2 or 3 tick kind of almost spikes. And would I re-enter a second time if you've got your entry time wrong the first time? Yeah, of course. But again, it's not just as simple as going, right, I was wrong, out the trade, I'm back in the trade. If you get out of the trade, give yourself some reference point. Maybe let a 5-minute candle close. And then you've got out of the trade, let that 5-minute candle close, and then make a decision. If the trade's going to go on side and going to be, a strong enough move, a 5-minute candlestick will mean nothing. It will just tell you where the market closed. You can look for the next one opening. And that should reaffirm if your trade's right or your trade's wrong. So give yourself a 3-minute candle, but give yourself a period of time before re-entering the trade. Give yourself some other justification. So trade management. Okay, when you're in a trade, you have to know how to manage it. So you've got a firm system in place for this. So of course, not all trades we manage in a fixed way. Again, back to everything I keep saying, we have to be flexible but have a certain point of discipline. So we have to have some sort of goals in place, and we have to have some sort of realistic outcome. So you have to be prepared to exit a trade early, but not allow yourself to become obsessed with taking profit. Okay, so all that means is that we're never going to get the perfect exit point, but we're looking to make 30 ticks, and the market's struggling to make them extra 5 ticks. It doesn't matter. If we made 25 ticks out of that trade, That's good enough. Let's get out. Let's get out, bank our profit, and look for the next opportunity. But then if the trade is on side 5 or 6 or 7, 10 ticks, then again, try and let it reach your goal. Don't just, take profit because it's there on the table. If you've waited for this trade and you expect to get 30 ticks out of it, at least take half. Half your profit out halfway through. So take half your profit at 15 ticks and let the rest run. Put your scratch in place. So then, you're not losing any money on the trade. These are just the simple strategies when you're managing a trade that you need to be thinking about. Yeah? Because if you just take profit, immediately when it's on the table, then you're going to have to look to get in that trade again. Yeah? And maybe then you can overtrade, and then you're going against your trading style, your trading system. So you need to think how you'll change in dynamic and volatile markets. How you're going to amend your system when, signals, when you've had significant increases or you've had significant drawdowns to your trading capital. These are the things that are going to affect you as a trader. So, as we mentioned in earlier topics, your exit strategy is, quite a significant part of your trading, but it's how you put it all together that's important. You need to know what signals are going to get you into the trade in the first place. You need to know your goals of where you want to get out for a profit or a loss. Then you have to manage the trade, when you're actually in it, and stick to your rules. If it's not going with you and the trade's not looking good, then bang, we go to our risk management strategy. We should know where our exit point is already. The trade isn't going right. I'm out this trade. I'm going to wait for the next opportunity. If the trade is going right, okay, what are my goals? I want to make 30 ticks. Where am I in that point? Okay, well, 15 ticks in. Okay, the markets are looking a little bit undecided. I've looked at this indicator, that indicator. I'm going to lock in half my profit, put a stop in. So if the trade does go where I expected, I can still make profit on that. If it doesn't, I've still banked half my profit. I'm going to look for the next opportunity. It sounds very simple, but then how many people actually approach a single trade in that way? Yeah, ask yourselves honestly. And if you do, then that's very good. You're already, over halfway there to being a very successful trader. But it's having the confidence and the ability to ask yourself these questions, and if they are right, carry on, and if they're not going with you and they seem to be going against your plan, also being strong enough to say, okay, I've identified I'm not trading this particular trade well, let's get out of it for a small loss, rethink, take a little break, and look for the next opportunity. So again, it's all about asking yourself questions and asking yourself what's relevant. So number one, what system of stops are you employing? Yeah, as we mentioned, are you using trailing stops or fixed stops? So just as that example I gave you is a perfect one. So you've got a fixed stop for your overall if your trade's wrong, and then you're going to use trailing stops when your trade is on side to lock in some profit, and then if the trade doesn't go exactly where you want to go, you've got a trailing stop that stops you out for a profit, an on-side trade. So how will you manage your stops once it's on side? Yeah? Are you going to move it with your risk? Are you going to go to 20 or 50% of your on-side target? Yeah? Or would you let it, completely retrace and hit 100% of what your entry point? So these are things you need to think about again before you get into the trade. How are you going to manage it when it is? So number three, how will you amend your stop once it's hit its target? If you've said, I think this trade is going to go for 30 ticks, so within a relatively small amount of time, you've hit that 30 ticks, are you right? Yeah? Obviously you're right. But if it breaks through that, where could the market go? What's your next level? Maybe at that point again, we take half our profit out, we put our stop in place, and we let the breakout happen and see how far we could run that trade. Yeah? So these are things, again, you just need to keep asking yourself constantly when you're in this trade, if you are right, and you've not had that finite fixed stop hit, yeah, how do you manage the on-side process? What realistically could you make out of that trade? Yeah, what's achievable? So then again, number four, will you split your stop and try to keep a lower risk? Again, this is just another way of managing trailing stops. If you want to take profit out, you can put trailing stops in, so the market does come against you. When you're on side, you can just have these stops in place to lock out some profit. Again, very simple techniques and things that are readily available on most trading platforms. So remember, a stop's where you get out of the trade, yep. And obviously, is generally on the downside or a trailing stop when you're in profit. Just to clarify that if people don't know what stops are. So number 5, how will you trade volatile markets? Again, another technique I've told to a lot of traders in recent times, and this is, highly professional traders, people who've been trading for years, cut your size. Yeah? Cut your size. Cutting your size enables you to trade with a bigger stop and allows you to encompass that volatility. So if markets are moving 2, 3, 4% a day and moving very aggressively, trade smaller size. You can still make the same money because markets will move a lot further. So number 6, how will you change your trade dynamic after a winning-losing cycle? So again, this really comes back to psychology. If you've had 3 losing trades, what are you going to trade next? Are you going to trade the same size or are you going to trade smaller size? Yeah? You're going to trade the same strategy. All these things you can think about. If you've had 3 winners, then what are you going to do? You're going to wait for the perfect opportunity and trade bigger size because you've got a bit of a cushion. These are the things you need to think about, especially when you're in good and bad cycles. Yeah, there's no point in doing the same thing over and over again if it's wrong, and just losing more and more money. If you're wrong and not trading well, and you still want to continue trading, trade smaller size. Try and make your losses back slowly. Don't try and make it back in a casino style, even double trouble. Yeah, don't just put a double size trade on and try and make all your losses back in one trade. It doesn't happen, and if it does, you'll end up just kidding yourself. You'll try it again, and then it won't. It's not sustainable. Yeah, that's gambling. That isn't trading. So number 7, how often will you check your signals? Okay, and news services. How you're gonna check the squawk? Are you gonna check it every 30 minutes, every hour, every day, every week? These are things we're talking about, the fundamentals. We have to understand, what's happening in the markets, what's coming out, what we need to be looking at, and who's saying what. So again, a lot of things coming out of the Eurozone, a lot of things happening with Greece, Italy, Portugal, Spain. So we need to know who's talking. We need to know who the foreign ministers are, who the technical advisors are. Because these are things that when they speak, the market will listen to and react. So trade management is really the real key to trading success. So everything is interlinked in everything that I teach. Okay, so there's no point doing one thing perfectly and the rest badly. So again, it's just like my golfing analogy. If you can drive and you can hit the irons, yeah, but you can't putt, would you class yourself as a successful golfer? There's no point doing all the hard work and then falling at the final hurdle, not being able to put the ball in the hole on the green. So if you can't plan correctly, and then you can't manage your trade effectively, and you can't exit when you're wrong or exit when you're right, these things really need to be how you approach a trade. It comes in 3 parts. It's not as simple as clicking the button to get in and clicking the button to get out. There's 3 distinct parts to any trade. Yeah, why you've done it, what you're doing when you're in it, and why you get out of the trade. So if you just have a little bit of a thought about that, maybe that's as simple as you can make your trading plan based on them 3 rules. But if you do think about them, and you do have some little strategies in place, or you do have some risk-reward ratios, or again, just some levels or anything, it's going to give you confidence and it's really going to give you the edge. So your exit strategy. So you always have to have an exit strategy planned for every trade before you put a trade on. So again, you need to focus on your system for placing stops. As I've said, you need to know a finite stop of how far a trade can go against you before you class that as a wrong trade. Yeah, and therefore you need to know where you're going to get out for a good profit, or where the markets could realistically go to. So therefore, how long you have to hold this trade for. Okay, so it's simple to hold a trade, yeah, and it's easy to hold a trade to go further offside and against you than it is to take a trade and let it run when it's onside. Because everyone hates to realize a loss and everyone loves to take a profit. So again, just by being aware of where we are in the trading range when we're onside, or where our levels are, or where the market could go to, that's when we start to think and play with and manage our onside position. And when we're offside, we have the feelings and the thoughts that we don't want to get out of this because we don't realize a loss. But if we put it in our head that the smaller the loss, the quicker we can trade again, because we're wrong, wait for another 5-minute candle, and then get back into the trade, and we haven't taken on stress or a big loss. If we approach it in that way, again, we're starting to be a bit more structured, and we're going to have a better chance of making a successful trading career. So the exit part of your plan should also include exit strategies for all the types of trade you're likely to be placing. So all that means is if you are scalping today or you're position trading today, that you're using the right kind of stops, you're using the right kind of attitude, risk rewards. It's all back to your plan. If you identified it's a breakout day, then we trade our breakout day routine. If it's a ranging day, we trade our ranging day routine. So your stops and risk reward should be in place for that. So like I said, in these markets, you really need to be a cross between a momentum and position trader. Scalping is very, very difficult and means that you're going to run the risk of over trading, getting too many false signals. So I recommend, from experience, there's generally 3 opportunities in the morning, 3 or 4 opportunities in the afternoon. So you should be looking to trade no more than 10 times in a day, and you base your risk-reward ratio all around that. Okay? So again, ask yourself these following questions. It's all about self-talk. It's all about asking the questions that only you can answer. So what level of risk are you willing to take in each trade and that particular strategy? Do you prefer to split your stops or use fixed stops or trailing stops? Again, what's your overall risk-reward ratio? What you're looking to achieve? So therefore, where should your out be? Number 3, how will you exit the trades when fundamental news comes into the market? If you think about acts of terrorism, if you're very, very bullish to S&P and an act of terrorism happens, then what are you going to do? Are you going to wait for the market to make a decision, or are you going to quickly get out of the trade and trade with the market? Okay? They're the things you need to think about. And how often are you going to check your signals? How many times will your trading strategy give you a signal? Are you trading off 15-minute candles? Or are you trading off hourly, off dailies? How many times in a day do you want to trade? Therefore 10, as I've suggested. So maybe you trade off 30-minute candles. That will give you enough signals to justify trading 10 times. And number 5, how often are you going to reassess your exit strategy? Will it be monthly? Will it be weekly? Again, by analysing your exit strategy and on your trades, you'll see a pattern of what's working and what's not working. The psychology. Again, there's a whole module on psychology. It's something that's very underrated in trading, but I find it really does give you a massive edge. So if you're not mentally prepared to trade, then the chances of success will be limited. You need to think about how you intend to mentally prepare for trading. People have, rituals, people give themselves a good talking to. And it might sound funny, but people do this for every day. If you look at a 100-meter sprint, for instance, when the sprinters line up, how many people are, saying things to themselves, muttering things under the breath, getting their mind in tune? We don't have to go to that extreme. But if we sit down, we've done our preparation, maybe we say, okay, done my preparation, I know where my levels are, I know where my stops would be for trades, I know what the overall trend is. I'm feeling good, I'm feeling prepared, I've done everything I can to be a successful trader today. These little things can give you the edge. And again, it can de-stress you, it can put you in the right frame of mind, it can just give you that few minutes just to kind of, look at yourself, look at your plan, look at the markets and go, okay, I've done everything I need to do and, I'm ready. So, it's also worth noting about the post-trade routine you'll have, okay? There will be a lot of frustrations you have with losing trades, and there'll be a lot of frustrations you have in the day. You'll have the ups of making money, the downs of losing money. So, it's very important to be mentally prepared before you trade, but then at the end of it, to have some closure. So, just read through your trading logs or look at your trading statement and go, yeah, good trade, bad trade. Why did I do that? Oh, for this reason. Oh, okay, well, that's mine. I won't do that again. And then you kind of, talk through it with yourself, justify why you did things, why you didn't do things, and then, put it to bed. Tomorrow's another day, but, you've put a line under that particular day. You've hopefully had your strategy in place, your risk reward in place, so you've not lost too much money, or if you followed your trading plan correctly, you obviously have made money, and you're up the required amounts for that particular day, week, etc. And then that's you're ending the day on a high. And that's the things you need to hold on to and take into the next day. So again, ask yourself the following. So how will you psychologically assess yourself from trade to trade? You can do it as simple as, give yourself 1 out of 10 for how you were feeling or how well you did during that trade. 1 being bad, 10 being good. Again, review it at the end of the week, see if you can see a pattern. How often are you going to take a designated break from the markets? From personal experience, I've sat there for 14 hours a day. It's not healthy. You need to take a step back, go make a cup of tea. You can't trade every opportunity. So again, how you prepare each day for the stresses of trading. Are you going to keep a diary of your mental state? Are you going to, or are you going to ignore it completely and just say, this is my trading time, so I'll think about nothing but trading? Again, it's entirely up to you what works for you. How you deal with frustrations, anger, or negative emotions. When you're trading badly, what you're going to do? You're just going to keep trading the same size. You're going to cut your size, or you're going to trade less. Yeah, not keep doing things that are wrong. Yeah, when you know they're wrong, try and change that. Try and redress the balance. And how are you going to ensure you don't overtrade or undertrade? Yeah, if you're overtrading, why is that? You're not sticking to your plan. Have you not got your goals in place? If you're undertrading, have you not looked at your signals closely enough? You're not looking at the market closely enough, or maybe even the market's not doing anything, so you're deciding to not trade. That's just as relevant. That's just as valid. Okay, guys. Well, there's quite a lot to take in there, to be honest. That's my take on why we should have a trading plan, why we should put some sort of structure to our day, our week, our month. So if we've got any questions, anything they'd like to ask, does anybody out there use a trading plan? Nope. Has anybody thought about how they trade? Has anybody thought about how they manage a trade? Has anybody identified with any parts of this section or any section we've had? Yep, the ability to use stops. Okay, Joseph, you're just in the process of creating your trading plan. Wow, that's excellent. That's good timing. So again, are the elements that we've talked about today that you've put in your trading plan? Are there elements that you might have missed out? Is there anything that, this presentation has thought, yes, actually, I need to think about that particular thing. I need to think about where my stops are going to be before I put a trade on. Or I need to, reassess when I'm having a bad run, that, I don't just start trading straight away, that I think about these things, I take a step back, I wait for maybe a 5 or a 10 minute candle to close before I retrade. Right, well, excellent. I'm glad you all enjoyed it, guys. I mean, that's obviously why we're here. What I will do is, obviously, I have a pre-designed trading plan that I use, that I've written. Obviously, I will get your email addresses, so I'll send you a follow-up email after this, and I'll attach the trading plan, so you can take it away. You can try it. If it works, that's fine. If it doesn't work, then perhaps try amending it. It's just that all these things are a guide. Without being able to see how you trade, without seeing your trading style, or seeing, what your capital requirements are on your products, I can't tell you the right risk reward, and I therefore can't tell you the right kind of trading plan. All I can give you is something that I've developed and that I've used, and you can take it away and use it. And again, all these things are designed for you to take out the bits that work for you and ignore the bits that don't. It's very, very difficult when you're teaching people different abilities and different stages in the trading career, because everyone acts in a different way, and everyone acts in a different way depending on their experience. So I just try and give you all the examples of things I've used that other people that are much cleverer than I am have told me how to use in the past, and then put it all together in a format that allows you to take what does work for you and what doesn't work for you to strip out. How does the trading plan look? Well, it's basically set out on an A4 piece of paper. So at the top you have, again, your current balance, how much profit you're looking to make today, how much you're looking to loss. There's a section for your goals, a section for your key targets, and then there's some other kind of analysis tools you can use to see how you actually performed on the day. So it's, again, I mean, this is things that I use, to trade professionally for a living. Again, I'm not saying that it's going to be right for everybody, but it'll give you some basic framework in order to kind of make you think during the day of what you should be doing. So like I said, I'll send you all a copy of that. It's absolutely no problem at all. And you can choose to use it or take what you want. Okay, do I have tactics of staying in a trade, e.g. max, fib, retracement, etc.? Well, as I mentioned with the managing a trade part and having your goals and having your exit strategy, there's nothing really that ever works all the time. The thing I tend to use for staying in a trade is things like momentum, things like overall levels. So if I'm on side in a trade, it's time to take a look at the bigger picture. So I generally trade off 15 minutes. So I'm trading off 15-minute candles. If I'm looking for an exit point, what I will then do is go to my hourly candles, yeah, and see where the market could possibly extend to. You know, what the volatility was in the previous candles in the previous days. And then perhaps move out to 4 hours or even dailies, yeah. And then you can put different things in like your Fibonacci around that. But then as long as you know where the market could possibly go, in respect to it, where it's been in the previous time frames, then you can give yourself levels of where the market could possibly extend to. So you can use things like Fibonacci, you can use things like your Bollinger Bands, your moving averages. But again, it's down to you. It's down to what works for you. What works for me might not be what's the best thing for you, Mish. So what I would do is just look back at previous trades of when you've got out of a trade and then the market's gone exactly what you thought it was going to be, so you've got out too early. And then look at the indicators you've been looking at. So when next time it happens, say, okay, I was in this position before and these things happened and I got out of the trade too early. Yeah. And then use that to your advantage and stay in the trade. Perhaps bank some profit and run the rest, or just hold on to the trade. Colin, where in the UK are you from? You recognise the accent. Well, I'm actually originally from Bolton, which is just outside of Manchester. However, I've lived a few different places. I'm currently based in Gibraltar, and I'll be presenting as of the next few weeks from Jersey. So yeah, I've been out of the UK for about 10 years now, so hopefully the accent's not too confusing. But yeah, that's a little bit about me, Colin. Oh, no, not a million miles from Wigan. No, not a million miles at all. 20 miles, in fact. Okay, Try and Trade is asking, do you have a time that you will allocate to stay in with for an intraday trade? Well, again, that's a difficult question to answer. If I'm trading on 15-minute candles, then I will always look for the next 15-minute candle to close before I get out of a trade. So maybe if it doesn't close within my risk-reward parameters, I'll let another 15-minute candle close. So I'll base it 15 minutes at a time. But again, it all depends on the market conditions or how much I'm looking to make out of that trade. So again, it's very difficult to say, Try and Trade, you know, what's the right amount of time. I think in all trades, you have to give yourself at least 15 minutes. So even if you're trading off 5-minute candles, give yourself the ability to look at 3 5-minute candles, yeah, and where they close in relevance to your entry point. Let the market do what it needs to do. You know, you're not going to be right instantly. You never just put a trade on and it goes fully onside. Yeah, the full amount you want. You know, that's why we have charts, because the charts take time to form. So again, I'd say probably 5 minutes minimum to 15 minutes. You have to stay in the trade. That's what I'd say to you. Okay, Colin, you're in Portugal and you're from Chester. I know Chester very well. And yeah, I have a place in Valdelobo in Portugal, so I go there quite a lot. Okay, if you have a target and it's struggling to get there, would you just exit? Again, like I've said to you, Try and Trader, yeah, it's all about managing the trade on side. So if it's struggling to go where you think it's going to go, yes, you can just exit the trade. If it looks like it's going to continue, you've already banked some profit, then you can re-get into that trade. Yeah? If the market's telling you it's struggling, then maybe you don't want to take that pain on yourself. So exit for a profit and then wait for the market to reconfirm. So again, look for your 5-minute candles to form. See when you exit the trade where it closes is on the moving average. Where is it in relation to the RSI? Where is it in relation to your Bollinger Bands? Yeah, the markets will always give you more than one opportunity to get into a trade and to trade. So yeah, there's nothing wrong with taking out profit. And if you still think you're right, then maybe take out half your profit, put a stop in, and let the rest run on. That's the main strategy I use. If the market's struggling, I will take some profit out, put a stop in. So if I'm wrong, fine, we get stopped out. We still made money. If I'm right, I can still put more into the trade as I'm going with the momentum. So good questions there, Try and Trader. I like them. Okay, people asking for my email. I've many emails, but you can get me on this one. What's the best one? So even if a target and it is struggling to get there, would you just leave it? Yep, okay, we have that question. Right, any other questions, guys? Anything else you'd like to ask? Okay, we still, I know it's a fairly long session this, I've done a lot of talking, but that's my job, I guess. So any other thoughts on the markets? Any other thoughts on, again, going into the markets with a style? Well, part 2 is I'm going to actually talk through the trading plan and how you build it up and what it actually is. And it talks a little bit more about the other 8 aspects of the course that I've written and the other 8 aspects we need to know about. There's a lot to know about trading, and we invest these 10 hours. It will certainly give you an overall edge to trading, because I know. Because I've done it. I've been that graduate trainer. I've been trader. I've been professional risk manager, floor manager, and I've trained hundreds of traders to make money. So I know what works. So I'm saying I haven't got the secret. I haven't got all the answers. That's for you to take away my information and put it into your style and to your risk reward and your attitude and style of trading. Okay, what do I use as my targets? Well, like I said, again, I generally use daily levels and hourly levels as targets. Again, I look to get involved in the markets when they're at their extremes. So if you look at things like Bollinger Bands, for instance, they tend to work very well in these markets. So the markets don't break out and we close below the top end of a Bollinger Band, then the first point is to look at the first point is to look at the moving average and then the lower end of the Bollinger Band. So that's what I look at intraday, things like that. So hopefully that helps you in intraday trader. Was the UK too cold for me? Good question. I don't know if you've ever been to Bolton, but it's not the most exciting of places. So no, that's why I left Bolton. I fancied a bit of an adventure. No problem at all, Try and Trader. These are the questions that are going to help other people. These are the questions that we should be asking. They're very, very insightful questions, and I'm happy to answer any of them. Okay, guys. Anything else we'd like to ask? Anything else that's come to mind? Again, like I say, I do these presentations, and there's a lot of information in them, but there's a lot of information you need to know about trading. There's no definitive answers, and there's no right or wrong way to trade, and we can only really go off what how we're feeling and what we're doing. Trading is difficult. Oh, you're still waiting for the email address? Okay, I thought I did put that in. Okay. Put both. Yep, there we go. Sorry. So yeah, that's the email you can get me on. Obviously, I can answer any questions. I know people don't generally like to speak over chat windows, but again, we're all in the same boat here. We're all interested in trading. We're all passionate about it. I can sense that from your questions. Okay, some people say that the Aussie dollar against the Japanese yen is the direction. Do you agree? The market direction? Interesting. Again, Colin, what you have to do is you have to question the motives and the reasons why people are saying this. A lot of people look at the Aussie dollar at the minute. It's not for me, to be honest. I look at the facts. You know, I look at what's happening in Europe. I look at what's happening in the US, and that's how I build my overall stance. You know, what's actually happening in the markets. And yeah, I mean, currencies are a big thing to look at, to be honest. They can give you that edge. So when I say about your planning and preparation, you know, always first thing in the morning, check what the currency pairs have done overnight. And if the Aussie dollar, the Aussie yen is moving in a particular direction, then try and match up to the markets. Maybe it'll give you the edge for a certain period of time, and then maybe it'll change. But, you know, everything goes in cycles. So you can't always, you know, everything won't correlate at the same time. So sometimes things will trend with other things, sometimes they won't. I mean, that's just how markets work. It's whatever, as I keep saying, whatever works for you and gives you the confidence to trade. Okay, Buki, well, you've seen me trade, if you've watched my live trading sessions, I generally trade the S&P for US figures. I was a big DAX trader, and, you know, again, I don't particularly mind. I can and have traded most things. I don't really trade that frequently these days, but yeah, I still like trading the American markets, to be honest. All right, guys, we've got a few minutes. Any final questions I need answering? Do I support Man U? No, I support Liverpool, funnily enough. So having another interesting season, I'm afraid. But I did used to live in Castlefield, so I looked over the Old Trafford Stadium. I do trade, Joseph. I do trade. I just don't trade as often. Like I said, you can watch me on InterTrader. I trade 2 live figures a month, so non-farm payrolls, and I'll be trading on the 22nd, new home sales. So you can watch me trade them. I'll trade them live and make money. How about that for a statement? All right, guys. Well, I really appreciate you all turning up. Okay. No, I don't know Jed O'Neill. I think there's about 250,000 people in Bolton. So no. If you know anyone in Gibraltar, there's only 30,000 people. I probably know them. All right, guys. Well, I think that's pretty much for this session. As I said, I will get the emails through probably tomorrow. So I'll send you a follow-up email, and you'll all get the PDF of my trading plan. It's been an absolute pleasure. And for the people that are staying on, I'll speak to you very soon. For them that aren't, I will see you next time. Cheers for tuning in, guys.